Personal and business finance plays a crucial role in shaping decisions for both individuals and organizations, helping you understand how money works and how to manage it confidently. This unit introduces key areas such as personal money management, sources of financial guidance, essential accounting language, and the main tools businesses use to plan and monitor their performance. Through this, you gain a strong foundation for future study or employment, developing the knowledge needed to handle personal finances and understand how businesses operate financially. The ability to handle money received and to control money paid is a fundamental requirement for personal and business success. Money has many functions and roles that it must fulfill. The functions of money are to act as a unit of account, a means of exchange, a store of value, and as legal tender. A unit of account means money provides a common measure to value goods and services. A means of exchange means money allows people to buy and sell goods and services without the need for bartering. A store of value means money can be saved and used in the future while maintaining its worth. Legal tender means money is officially recognized by the government as an acceptable form of payment for debts. The role of money is to enable trade, measure value, store wealth, and settle debts within an economy. The factors that affect and influence the role of money include personal attitudes, different life stages, cultural and religious beliefs, life events, external influences and trends, and interest rates. Risk is the chance of losing money or value, and attitudes towards risk affect the role of money, as cautious individuals may save more while risk-takers may invest for higher returns. Reward is the potential gain from financial decisions, and attitudes towards reward affect the role of money because people motivated by reward may seek higher risk opportunities for profit. Borrowing is obtaining money with the agreement to repay later, and attitudes towards borrowing affect the role of money because cautious individuals may avoid debt while others may use borrowing to finance major purchases or investments. Spending is using money to purchase goods and services, and attitudes towards spending affect the role of money because those who spend freely may have less available for saving or investing. Saving is setting money aside for future use, and attitudes towards saving affect the role of money because those who value security will prioritize building savings over spending. In childhood, financial needs are limited and depend on parents, so the role of money is to introduce basic financial understanding and the value of saving. In adolescence, individuals begin to manage small sums, learn budgeting, and develop spending habits, so the role of money grows in teaching responsibility and independence. In young adulthood, financial needs expand with education, housing, and work, so the role of money focuses on managing income, debt, and savings effectively. In middle age, individuals face responsibilities such as mortgages, family expenses, and retirement planning, so the role of money centers on stability and long-term investment. In old age, income often reduces while healthcare and living costs increase, so the role of money shifts towards maintaining financial security and comfort in retirement. Culture affects the role of money because religious and ethical beliefs influence how people view wealth, debt, spending, and charity. External influences and trends affect the role of money because factors like technology, inflation, or global markets shape how people earn, save, and spend. For example, technological advancements such as digital banking make money management faster and more accessible, while inflation reduces purchasing power and encourages saving or investing to preserve value. Interest rates are the percentage charged on borrowing or earned on saving over time. The costs of borrowing versus the reward of saving influence the role of money because high interest rates discourage borrowing but encourage saving, while low rates make borrowing cheaper and saving less attractive. There are many reasons why an individual would plan their expenditure. An individual would plan their personal finances to avoid getting into debt by budgeting and living within their means. They would control costs by monitoring spending and prioritizing essential expenses. They would avoid legal action and/or repossession by meeting debt repayments and managing bills on time. They would remain solvent by ensuring income exceeds expenditure. They would maintain a good credit rating by repaying loans and credit cards promptly. They would avoid bankruptcy by managing debt responsibly and seeking advice when facing financial difficulty. They would manage money to fund purchases by saving regularly and planning ahead. They would generate income and savings by investing wisely and setting aside part of their earnings. They would set financial targets and goals by identifying priorities such as buying a home or retiring comfortably. They would provide insurance against loss or illness by obtaining suitable cover to protect their finances. They would counter the effects of inflation by investing in assets that maintain or increase in value over time. The different ways to pay are cash, debit card, credit card, check, electronic transfer, direct debit, standing order, prepaid cards, mobile payment apps, contactless cards, charge cards, store cards, mobile banking, bankers' automated clearing services, faster payment service, and clearing house automated payment system. Cash is physical money used for instant transactions where the advantage is immediate payment with no fees, and the disadvantage is the risk of loss or theft. A debit card is linked directly to a bank account where the advantage is convenience and control over spending, and the disadvantage is that it requires sufficient funds in the account. A credit card allows borrowing up to a limit where the advantage is flexibility and potential rewards, and the disadvantage is interest charges if not repaid in full. A check is a written order to pay money from one account to another where the advantage is a secure record of payment, and the disadvantage is the delay before funds clear. An electronic transfer is a digital movement of money between accounts where the advantage is speed and convenience, and the disadvantage is that errors are difficult to reverse. A direct debit allows a company to collect regular payments from a customer's account where the advantage is automated bill payments, and the disadvantage is less control over the payment date and amount. A standing order is an instruction to make regular fixed payments where the advantage is consistency for recurring bills, and the disadvantage is the need for manual updates if payment details change. Prepaid cards are loaded with a set amount of money where the advantage is controlled spending and reduced risk of debt, and the disadvantage is potential fees and limited top-up options. Mobile payment apps allow payments using smartphones where the advantage is convenience and quick transactions, and the disadvantage is reliance on technology and internet access. Contactless cards enable tap-and-go payments where the advantage is speed and ease, and the disadvantage is spending limits and security risks if lost. Charge cards require full repayment each month where the advantage is interest-free use, and the disadvantage is high penalties for late payment. Store cards are offered by retailers for purchases in specific shops where the advantage is discounts or rewards, and the disadvantage is high interest rates if balances are not cleared. Mobile banking allows customers to manage finances through a smartphone app where the advantage is 24/7 access to banking services, and the disadvantage is vulnerability to cyber threats. Bankers' automated clearing services is a system for transferring funds electronically where the advantage is reliability for regular payments, and the disadvantage is that transactions take around 3 working days to clear. Faster payment service allows near-instant money transfers where the advantage is speed and convenience, and the disadvantage is that it may have lower transaction limits. Clearing house automated payment system is a same-day payment system for large transactions where the advantage is guaranteed same-day settlement, and the disadvantage is high transaction fees. The different types of current accounts are standard, packaged or premium, basic, and student accounts. A standard current account is the most common type of bank account where the features include a debit card, checkbook, overdraft facility, and online banking. The advantages of a standard current account are convenience, access to various banking services, and the ability to manage day-to-day finances easily, while the disadvantages are potential overdraft fees and limited additional benefits. A packaged or premium current account is a type of account that offers extra services for a monthly fee where the features include travel insurance, breakdown cover, and preferential interest rates. The advantages of a packaged or premium current account are access to added financial and lifestyle benefits, while the disadvantages are the monthly cost and the risk of paying for benefits not used. A basic current account is a simplified account for those with poor credit or low income where the features include a debit card and the ability to receive income and make payments but no overdraft facility. The advantages of a basic current account are that it provides access to banking for those unable to open standard accounts, while the disadvantages are limited features and no access to credit facilities. A student current account is designed for individuals in higher education where the features include interest-free overdrafts, discounts, and incentives for managing finances while studying. The advantages of a student current account are the ability to borrow interest-free and access student-specific rewards, while the disadvantages are that overdraft limits vary and must be repaid after graduation. There are many financial products that an individual can use, whether it be to borrow, save, or insure their property. The different types of borrowing are overdrafts, personal loans, hire purchase, mortgages, credit cards, and payday loans. An overdraft is a short-term borrowing facility linked to a current account where the features include a set limit, interest charges, and repayment flexibility. The advantages of an overdraft are quick access to funds and flexible repayments, while the disadvantages are high interest rates and potential fees if the limit is exceeded. An overdraft would be suitable for individuals needing temporary financial support, such as covering short-term cash flow issues or unexpected expenses. Personal loans are borrowed sums repaid over a fixed period where the features include fixed monthly payments, set interest rates, and a defined loan term. The advantages of personal loans are predictable repayments and access to larger sums, while the disadvantages are interest costs and the risk of debt if repayments are missed. Personal loans would be suitable for individuals planning large purchases or consolidating debts over time with stable income to meet repayments. A hire purchase is a type of credit agreement used to buy goods where the features include an initial deposit, regular installments, and ownership transferred after final payment. The advantages of hire purchase are spreading the cost of expensive items and eventual ownership, while the disadvantages are higher overall cost and risk of repossession if payments are missed. Hire purchase would be suitable for individuals wanting to buy vehicles or appliances without paying the full cost upfront but who can commit to regular payments. Mortgages are long-term loans used to purchase property where the features include fixed or variable interest rates, long repayment terms, and secured borrowing against the home. The advantages of a mortgage are the ability to own property and build equity, while the disadvantages are long-term debt and the risk of repossession if repayments are not made. A mortgage would be suitable for individuals with stable income who wish to buy a home and can afford regular long-term repayments. Credit cards are revolving credit facilities that allow spending up to a set limit where the features include flexible repayments, interest on unpaid balances, and potential rewards. The advantages of credit cards are convenience, purchase protection, and potential rewards, while the disadvantages are high interest rates and the risk of accumulating debt. A credit card would be suitable for individuals who manage spending responsibly and repay balances regularly to avoid interest. A payday loan is a short-term, high-interest loan intended to cover expenses until the next payday where the features include small loan amounts and rapid approval. The advantages of a payday loan are fast access to cash and minimal eligibility requirements, while the disadvantages are extremely high interest rates and risk of debt cycles. A payday loan would be suitable only for individuals needing urgent short-term funds and who are confident they can repay it quickly without financial strain. Saving is the act of setting aside money from income to use in the future rather than spending it immediately. Investment is the act of using money to buy assets or financial products with the aim of generating a return or profit over time. The different types of saving and investment are individual savings accounts, ISAs, deposit and savings accounts, premium bonds, bonds and gilts, shares, and pensions. Individual savings accounts are tax-efficient accounts where the features include a yearly deposit limit, tax-free interest or returns, and access to cash or investment options. The advantages of individual savings accounts are tax-free growth and flexible access to funds, while the disadvantages are deposit limits and potentially lower returns compared to riskier investments. An individual savings account would be suitable for individuals seeking safe, tax-free savings options with easy access to their money. Deposit and savings accounts are bank or building society accounts used to store money securely where the features include variable interest rates, instant or limited access, and deposit protection. The advantages of deposit and savings accounts are security, simplicity, and accessibility, while the disadvantages are low interest rates and limited growth potential. A deposit and savings account would be suitable for individuals who want a low-risk way to save and access money easily for short-term needs. Premium bonds are government-backed savings products where returns are paid through a monthly prize draw instead of interest where the features include no guaranteed return and tax-free winnings. The advantages of premium bonds are security and the chance of winning tax-free prizes, while the disadvantages are the lack of guaranteed income and inflation reducing value over time. A premium bond would be suitable for individuals seeking a safe savings option with the possibility of occasional prize-based rewards rather than regular interest. Bonds and gilts are fixed-interest investments issued by companies or the government where the features include regular interest payments and repayment at maturity. The advantages of bonds and gilts are predictable income and lower risk compared to shares, while the disadvantages are lower returns and vulnerability to interest rate changes. Bonds and gilts would be suitable for individuals seeking steady, long-term income with lower risk exposure. Shares represent partial ownership in a company where the features include dividend payments and the potential for capital growth based on company performance. The advantages of shares are the potential for high returns and dividend income, while the disadvantages are the risk of loss if share prices fall and market volatility. Shares would be suitable for individuals willing to take higher risks for greater long-term rewards and who can manage fluctuations in value. Pensions are long-term savings plans designed to provide income in retirement where the features include tax relief on contributions, employer contributions, and restrictions on early access. The advantages of pensions are long-term growth, tax benefits, and financial security in retirement, while the disadvantages are limited access until retirement age and the risk of investment fluctuations. Pensions would be suitable for individuals planning for future financial stability and who are prepared to commit money for long-term retirement savings. The risks to saving are that inflation can reduce the value of money and that low interest rates may limit financial growth. The rewards to saving are safety, accessibility, and the gradual accumulation of funds for future use. Saving would be suitable for individuals who prefer low risk, want quick access to their money, or are planning for short-term financial goals. The risks to investment are potential loss of capital, fluctuating market values, and uncertainty in returns. The rewards to investment are the potential for higher profits, dividend income, and long-term capital growth. Investing would be suitable for individuals willing to take greater risks for higher returns, especially those focused on long-term financial goals such as retirement or wealth building. The different types of insurance products are car, home and contents, life assurance and insurance, travel, pet, and health insurance. Car insurance is a policy that provides financial protection against accidents, theft, and damage to a vehicle where the features include third-party liability cover and optional comprehensive protection. The different types of insurance policy for car insurance are third-party only, third-party fire and theft, and fully comprehensive cover. The advantages of car insurance are legal compliance, financial protection, and peace of mind, while the disadvantages are high premiums and possible excess payments. Car insurance would be suitable for all drivers, with comprehensive cover ideal for new or high-value cars and third-party cover suited to those driving older or less valuable vehicles. Home and contents insurance is a policy that protects buildings and personal belongings from risks such as fire, theft, or damage where the features include building cover, contents cover, and combined policies. The different types of insurance policy for home and contents insurance are buildings insurance, contents insurance, and combined buildings and contents insurance. The advantages of home and contents insurance are protection from financial loss and peace of mind, while the disadvantages are ongoing premium costs and exclusions in cover. Home and contents insurance would be suitable for homeowners and renters, with building cover necessary for property owners and contents cover beneficial for tenants and homeowners alike. Life assurance and insurance are financial products that provide a payout after death or after a set period where the features include fixed premiums, lump sum payments, and optional investment elements. The different types of insurance policy for life assurance and insurance are term life insurance, whole of life insurance, and endowment assurance. The advantages of life assurance and insurance are financial security for dependents and peace of mind, while the disadvantages are long-term costs and the risk of no return if the policy expires before death. Life assurance and insurance would be suitable for individuals with financial dependence or long-term commitments who want to provide for their family after death. Travel insurance is a policy that protects travelers against risks such as medical emergencies, cancellations, and lost luggage where the features include single-trip, annual, and specialist travel cover. The different types of insurance policy for travel insurance are single-trip policies, annual multi-trip policies, and long-stay or backpacker policies. The advantages of travel insurance are financial protection during trips and coverage for unexpected incidents, while the disadvantages are additional travel costs and exclusions for certain activities. Travel insurance would be suitable for individuals traveling domestically or abroad, with frequent travelers benefiting from annual policies and occasional travelers from single-trip cover. Pet insurance is a policy that helps cover the cost of veterinary treatment where the features include lifetime, time-limited, and accident-only options. The different types of insurance policy for pet insurance are lifetime cover, maximum benefit cover, time-limited cover, and accident-only cover. The advantages of pet insurance are financial assistance for vet bills and peace of mind, while the disadvantages are high premiums and exclusions for pre-existing conditions. Pet insurance would be suitable for pet owners who want to ensure they can afford medical treatment for their animals without financial stress. Health insurance is a policy that pays for private medical treatment where the features include hospital care, specialist consultations, and preventative services. The different types of insurance policy for health insurance are individual health insurance, family health insurance, and employer-provided group health insurance. The advantages of health insurance are faster access to medical care and choice of providers, while the disadvantages are high premiums and limited cover for some treatments. Health insurance would be suitable for individuals who prefer private healthcare or wish to avoid long NHS waiting times for treatment. There are many financial institutions that customers can use to receive finance, get protection, and receive information. These institutions also have many ways of communicating with their customers. The different financial institutions are the Bank of England, banks, building societies, credit unions, national savings and investments, insurance companies, pension companies, pawnbrokers, and payday loan providers. The Bank of England is the central bank of the United Kingdom, where its features include controlling monetary policy, issuing banknotes, maintaining financial stability, and regulating other banks. The advantages of the Bank of England are that it controls inflation and ensures financial stability, while the disadvantages are that its decisions can increase borrowing costs and limit public spending. Banks are financial institutions where their features include accepting deposits, providing loans, offering overdrafts, and managing payments for individuals and businesses. The advantages of banks are that they provide convenient access to financial services and secure storage for money, while the disadvantages are that they can charge high interest rates and fees. Building societies are mutual financial organizations where their features include being owned by members, offering savings accounts, and providing mortgages. The advantages of building societies are that they often offer better interest rates and a more personal service, while the disadvantages are that they have fewer branches and limited product ranges compared to banks. Credit unions are non-profit financial cooperatives where their features include being owned by members, providing savings accounts, and offering affordable loans. The advantages of credit unions are that they charge lower interest rates and support local communities, while the disadvantages are that they offer limited services and may have membership restrictions. National Savings and Investments is a government-backed organization where its features include offering savings products such as premium bonds and ensuring that all funds are fully guaranteed by the Treasury. The advantages of National Savings and Investments are that it provides a secure place to save and does not charge fees, while the disadvantages are that interest rates can be lower than those of other providers and product choice is limited. Insurance companies are financial institutions where their features include providing policies that protect against financial loss from events such as accidents, theft, or illness. The advantages of insurance companies are that they offer financial security and peace of mind, while the disadvantages are that premiums can be expensive and claims may be refused. Pension companies are organizations where their features include managing retirement funds and investing contributions to provide income in later life. The advantages of pension companies are that they help individuals save for retirement and offer tax benefits, while the disadvantages are that investments can lose value and funds are not easily accessible. Pawnbrokers are businesses where their features include lending money in exchange for valuable items that serve as collateral until the loan is repaid. The advantages of pawnbrokers are that they provide quick access to cash without credit checks, while the disadvantages are that interest rates can be high and items may be lost if loans are not repaid. Payday loans are short-term loans where their features include lending small amounts of money at very high interest rates to be repaid on the borrower's next payday. The advantages of payday loans are that they offer fast access to funds in emergencies, while the disadvantages are that they carry extremely high costs and can lead to debt cycles. The methods of communicating with customers are branch banking, online banking, telephone banking, mobile banking, and postal banking. Branch banking is when customers visit a physical location to carry out transactions and receive personal assistance, and its advantages are face-to-face support and secure cash handling, while its disadvantages are limited opening hours and the inconvenience of travel. Online banking is when customers manage their accounts through a secure website, and its advantages are 24-hour access and convenience, while its disadvantages are the risk of fraud and the need for internet access. Telephone banking is when customers contact their bank by phone to manage their accounts or seek advice, and its advantages are personal communication and convenience, while its disadvantages are long waiting times and security concerns. Mobile banking is when customers use a smartphone app to check balances, transfer money, or make payments, and its advantages are speed and accessibility, while its disadvantages are potential technical issues and security risks. Postal banking is when customers send and receive financial documents or make payments through the post, and its advantages are accessibility for those without digital devices and a written record of communication, while its disadvantages are slow processing times and the risk of lost mail. The different types of consumer protection for personal finance are the Financial Conduct Authority, the Financial Ombudsman Service, the Financial Services Compensation Scheme, and consumer credit legislation. The Financial Conduct Authority is an independent organization where its function is to regulate financial firms, its role is to protect consumers and ensure market integrity, and its responsibility is to enforce rules and take action against misconduct. The Financial Ombudsman Service is an independent body where its function is to resolve disputes between consumers and financial institutions, its role is to provide fair and impartial decisions, and its responsibility is to offer free and accessible complaint handling. The Financial Services Compensation Scheme is a government-backed scheme where its function is to protect consumers if financial firms fail, its role is to compensate individuals for lost savings or investments, and its responsibility is to maintain public confidence in the financial system. Consumer credit legislation is a set of laws where its function is to regulate how credit is offered, its role is to ensure that borrowers are treated fairly, and its responsibility is to prevent exploitation through clear contracts and responsible lending practices. The different sources of advice for personal finance are citizens' advice, independent financial advisors, price comparison websites, debt counselors, individual voluntary arrangements, and bankruptcy. The functions, role, and responsibilities of citizens' advice are to provide free and confidential guidance, to help individuals understand their financial rights, and to support people in managing money or resolving debt issues. The advantages of citizens' advice are that it offers impartial and free advice to everyone, while the disadvantages are that it can have long waiting times and may not provide specialist financial planning. The functions, roles, and responsibilities of independent financial advisors are to give professional and personalized financial advice, to guide clients on investments, pensions, and savings, and to act in the client's best interest under regulatory standards. The advantages of independent financial advisors are that they provide expert and tailored advice, while the disadvantages are that their services can be expensive and quality may vary. The functions, role, and responsibilities of price comparison websites are to collect and display financial products from multiple providers, to help consumers compare prices and features, and to ensure information is clear and accurate. The advantages of price comparison websites are that they save time and make it easier to find competitive deals, while the disadvantages are that not all providers are listed and data may be biased towards paying companies. The functions, role, and responsibilities of debt counselors are to help people manage debt, to create realistic repayment plans, and to provide emotional and financial support during repayment. The advantages of debt counselors are that they offer structured guidance and can reduce stress, while the disadvantages are that some charge fees and success depends on client cooperation. The functions, role, and responsibilities of individual voluntary arrangements are to provide a formal agreement between a debtor and creditors, to allow repayment of debts over time, and to prevent legal action while the agreement is active. The advantages of individual voluntary arrangements are that they stop creditor harassment and write off some debts, while the disadvantages are that they affect credit ratings and require strict adherence to payment terms. The functions, role, and responsibilities of bankruptcy are to provide legal relief for individuals unable to repay debts, to liquidate assets for creditor repayment, and to offer a financial fresh start after insolvency. The advantages of bankruptcy are that it clears most debts and allows a new beginning, while the disadvantages are that it damages credit history, may result in loss of assets, and can restrict future borrowing. There are many purposes of accounting, with many types of income and expenditure that will affect accounting. The purposes of accounting are recording transactions, managing the business through planning, monitoring and controlling, ensuring compliance to prevent fraud and follow laws and regulations, measuring performance, and providing control to assist with the prevention of fraud and the management of trade receivables and trade payables. Recording transactions is supported by accounting because it provides a clear and accurate record of all financial activity to ensure reliability in future decisions. Managing the business through planning, monitoring, and controlling is supported by accounting because financial information allows managers to plan effectively, track progress, and take corrective action. Compliance is supported by accounting because proper financial records ensure the business follows legal requirements and reduces the risk of fraud. Measuring performance is supported by accounting because it allows the business to compare results over time and assess whether financial objectives are being met. Control is supported by accounting because it helps identify discrepancies, monitor money owed by customers, and ensure payments to suppliers are made correctly to reduce fraud risks. The different forms of income are capital income and revenue income. Capital income is money invested into the business over a long period to purchase non-current assets. The different types of capital income are loans, mortgages, shares, owner's capital, and debentures. A loan is capital income because it is borrowed money from a bank or financial institution that must be repaid with interest over time. A mortgage is capital income because it is a long-term secured loan used to purchase property where the property acts as collateral. Shares are capital income because they provide funds from investors in exchange for ownership and possible dividends. Owner's capital is capital income because it is the money invested directly by the owner to start or grow the business. Debentures are capital income because they are long-term loans issued by the business to investors with the promise of fixed interest payments. Revenue income is money received through the day-to-day operations of the business. The different types of revenue income are cash sales, credit sales, rent received, commission received, interest received, and discount received. Cash sales are revenue income because they are payments received immediately from customers for goods or services. Credit sales are revenue income because they are sales made where payment is received at a later date. Rent received is revenue income because it is money earned from allowing others to use business property. Commission received is revenue income because it is payment earned for completing a transaction on behalf of another party. Interest received is revenue income because it is money earned from savings or lending activities. Discount received is revenue income because it is a reduction in the amount payable to suppliers, increasing the business's income. The different forms of expenditure are capital expenditure and revenue expenditure. Capital expenditure is money spent by a business to acquire, upgrade, or maintain non-current assets that will be used for more than 1 year. Current assets and non-current assets are categories of resources a business owns where current assets are expected to be converted into cash within a year and non-current assets are long-term resources used over several years. Tangible assets and intangible assets are types of non-current assets where tangible assets have a physical presence such as machinery or buildings and intangible assets have no physical substance such as patents or trademarks. The different types of capital expenditure are non-current assets that are either tangible such as land, buildings and premises, machinery and equipment, vehicles, fixtures and fittings, or intangible such as goodwill, patents, trademarks and brand names. Land is capital expenditure because it is a long-term tangible asset purchased to support business operations. Buildings and premises are capital expenditure because they provide the physical space where the business operates. Machinery and equipment are capital expenditure because they are used to produce goods or deliver services over many years. Vehicles are capital expenditure because they are used for business transport and deliveries over the long term. Fixtures and fittings are capital expenditure because they improve or equip the premises to support business activities. Goodwill is capital expenditure because it represents the value of the business reputation or customer loyalty acquired when purchasing another business. Patents are capital expenditure because they give the business exclusive rights to produce and sell an invention for a set period. Trademarks are capital expenditure because they legally protect the brand identity of the business. Brand names are capital expenditure because they are purchased to increase brand recognition and customer trust over time. Revenue expenditure is money spent on the day-to-day running of the business to maintain operations. The different types of revenue expenditure are inventory, rent, rates, heating and lighting, water, insurance, administration, telephone, postage, stationery, salaries, wages, marketing, bank charges, interest paid, straight-line depreciation, reducing balance depreciation and discount allowed. Inventory is revenue expenditure because it is the cost of goods bought for resale. Rent is revenue expenditure because it is a regular payment for the use of property. Rates are revenue expenditure because they are local taxes paid on business premises. Heating and lighting are revenue expenditure because they cover essential utility costs for business operations. Water is revenue expenditure because it is a recurring cost necessary for the premises. Insurance is revenue expenditure because it protects the business against risks and must be renewed regularly. Administration is revenue expenditure because it covers the cost of running the office and support functions. Telephone is revenue expenditure because it relates to communication services used daily. Postage is revenue expenditure because it includes the cost of sending mail and packages. Stationery is revenue expenditure because it is regularly used for office tasks. Salaries are revenue expenditure because they are fixed payments to employees. Wages are revenue expenditure because they are payments made to staff based on hours worked or output. Marketing is revenue expenditure because it promotes the business and drives sales in the short term. Bank charges are revenue expenditure because they are fees for banking services. Interest paid is revenue expenditure because it is the cost of borrowing money. Straight-line depreciation is revenue expenditure because it spreads the cost of an asset evenly over its useful life. Reducing balance depreciation is revenue expenditure because it allocates more of the asset's cost in the earlier years of use. Discount allowed is revenue expenditure because it is a reduction in the selling price to encourage prompt payment by customers. Types of sources of finance include internal and external sources available to businesses. Internal finance refers to money generated from within the business's own operations. Different sources of internal finance include retained profit, net current assets, and sale of assets. Retained profit is the surplus income a business keeps after all expenses and dividends are paid. Short-term and long-term advantages of retained profit include immediate access to funds without interest payments and support for sustainable growth over time. Short-term and long-term disadvantages of retained profit include limited dividends to shareholders and restricted external investment opportunities. Net current assets represent the difference between current assets and current liabilities, showing liquidity available for day-to-day operations. Short-term and long-term advantages of net current assets include improved immediate cash flow and long-term financial stability. Short-term and long-term disadvantages of net current assets include the need to reduce stock levels and the potential for damaged supplier relationships if liabilities are delayed. Sale of assets involves selling unwanted or unused items owned by the business to raise finance. Short-term and long-term advantages of sale of assets include quick access to cash and reduced maintenance costs over time. Short-term and long-term disadvantages of sale of assets include reduced operational capacity and the potential loss of valuable resources. External finance refers to money sourced from outside the business through individuals, institutions, or organizations rather than generated internally. Different sources of external finance include owner's capital, loans, crowdfunding, mortgages, venture capital, debt factoring, hire purchase, leasing, trade credit, grants, donations, peer-to-peer lending, and invoice discounting. Owner's capital refers to personal money invested by the owner into the business. Short-term and long-term advantages of owner's capital include immediate control without interest and strengthened equity over time. Short-term and long-term disadvantages of owner's capital include reduced personal savings and increased personal financial risk. Loans involve borrowed sums from banks or financial institutions that must be repaid with interest. Short-term and long-term advantages of loans include quick access to large funds and structured repayment over time. Short-term and long-term disadvantages of loans include regular interest payments and increased financial liabilities. Crowdfunding is the process of raising finance from a large number of individuals who each contribute small amounts. Short-term and long-term advantages of crowdfunding include immediate access to capital without interest and the creation of a supportive community for long-term growth. Short-term and long-term disadvantages of crowdfunding include the risk of failing to reach funding targets and potential damage to reputation if expectations are not met. Mortgages are long-term loans secured against property. Short-term and long-term advantages of mortgages include access to large sums of finance and lower interest rates over time. Short-term and long-term disadvantages of mortgages include the need for a deposit and the risk of asset repossession. Venture capital involves investment from individuals or firms in exchange for equity in the business. Short-term and long-term advantages of venture capital include access to expert guidance and funding and support for business expansion. Short-term and long-term disadvantages of venture capital include loss of ownership control and dilution of profits. Debt factoring involves selling unpaid invoices to a third party for immediate cash. Short-term and long-term advantages of debt factoring include improved cash flow and reduced risk of bad debts. Short-term and long-term disadvantages of debt factoring include reduced income due to fees and weakened customer relationships. Hire purchase is a method of acquiring assets through installment payments over time. Short-term and long-term advantages of hire purchase include immediate use of assets and the ability to spread costs. Short-term and long-term disadvantages of hire purchase include regular payment obligations and higher overall cost due to interest. Leasing involves renting an asset for a set period without ownership. Short-term and long-term advantages of leasing include access to assets without upfront costs and the ability to upgrade regularly. Short-term and long-term disadvantages of leasing include ongoing rental expenses and the absence of asset ownership. Trade credit allows a business to receive goods or services and pay for them at a later date. Short-term and long-term advantages of trade credit include improved short-term cash flow and stronger supplier relationships over time. Short-term and long-term disadvantages of trade credit include penalties for late payment and reduced creditworthiness. Grants are funds provided by governments or organizations that do not require repayment. Short-term and long-term advantages of grants include access to free finance and long-term support for development. Short-term and long-term disadvantages of grants include time-consuming applications and strict conditions on use. Donations are voluntary contributions made to support a business or cause. Short-term and long-term advantages of donations include immediate funds without repayment and improved public image over time. Short-term and long-term disadvantages of donations include unpredictability in income and lack of sustainability. Peer-to-peer lending involves borrowing money directly from individuals through online platforms. Short-term and long-term advantages of peer-to-peer lending include quick access to finance and potentially lower interest rates. Short-term and long-term disadvantages of peer-to-peer lending include platform fees and the risk of lenders withdrawing support. Invoice discounting uses unpaid invoices as security to access a percentage of their value as immediate finance. Short-term and long-term advantages of invoice discounting include improved cash flow and retention of customer relationships. Short-term and long-term disadvantages of invoice discounting include service charges and increased financial commitments over time. Break-even and cash flow forecasts are financial tools that help a business plan its finances by predicting when it will cover its costs and how money will move in and out over a set period. A cash flow forecast is a financial plan that estimates all expected inflows and outflows of cash to help predict the business's future liquidity. Inflows, or receipts, are the amounts of money coming into a business from various sources. The different inflows are cash sales, credit sales, loans, capital introduced, sale of assets, and bank interest received. Cash sales are inflows from customers who pay immediately for goods or services. Credit sales are inflows from customers who buy on credit and pay later. Loans are inflows from borrowed funds provided by banks or other lenders. Capital introduced is money invested into the business by its owners. Sale of assets is an inflow received when the business sells equipment, property, or other assets. Bank interest received is an inflow earned from money held in savings or other bank accounts. Outflows, or payments, are the amounts of money leaving a business to pay for goods, services, and expenses. The different outflows are cash purchases, credit purchases, rent, rates, salaries, wages, utilities, purchase of assets, value-added tax, and bank interest paid. Cash purchases are outflows for goods or materials paid for immediately. Credit purchases are outflows for goods or materials bought on credit and paid for later. Rent is an outflow for the use of business premises or land. Rates are outflows paid to local authorities for business property. Salaries are outflows for paying permanent staff. Wages are outflows for paying temporary or hourly workers. Utilities are outflows for essential services such as electricity, water, and gas. Purchase of assets is an outflow used to buy equipment or property for the business. Value-added tax is an outflow paid to the government based on taxable sales. Bank interest paid is an outflow for the cost of borrowing money. Cash flow forecasts are used for planning by helping a business prepare for periods of surplus or shortage. Cash flow forecasts are used for monitoring by comparing actual cash flow against predictions to identify variances. Cash flow forecasts are used for control by allowing managers to take action when cash flow problems arise. Cash flow forecasts are used for target setting by helping a business establish financial goals and benchmarks. The benefits of cash flow forecasts are that they improve financial planning, help avoid cash shortages, and support decision-making. The limitations of cash flow forecasts are that they rely on estimates, may be affected by unexpected events, and can quickly become outdated if assumptions change. A break-even analysis is a financial tool that identifies the point where a business's total costs and total revenue are equal, meaning no profit or loss is made. Costs are the expenses a business incurs while producing and selling its goods or services. The different types of costs are variable, semi-variable, fixed, and total. Variable costs are expenses that change directly with the level of output, such as raw materials or packaging. Semi-variable costs are expenses that have both fixed and variable elements, such as telephone bills that include a basic charge plus usage fees. Fixed costs are expenses that remain the same regardless of output, such as rent or insurance. Total costs are the sum of all fixed and variable costs incurred by a business. Sales are the total income a business earns from selling its goods or services to customers. The different types of sales are total revenue, total sales, selling price per unit, and sales in value and/or units. Total revenue is the total amount of money received from sales, such as £10,000 earned from selling 500 units. Total sales are the overall number of units sold or the total value of those sales. Selling price per unit is the amount charged to customers for one product, such as £20 per unit. Sales in value and/or units represent how much revenue is generated or how many products are sold over a given period. The formula for the break-even point is fixed costs divided by contribution per unit. The area of profit and loss is calculated by comparing total revenue to total costs, where the area above the break-even point represents profit and the area below represents loss. The margin of safety is the difference between actual or projected sales and the break-even sales, showing how much sales can fall before a loss occurs. Total contribution is calculated by subtracting total variable costs from total sales revenue, while contribution per unit is calculated by subtracting variable cost per unit from selling price per unit. The benefits of contribution per unit are that it helps businesses assess product profitability and make pricing decisions, while its limitations are that it ignores fixed costs and assumes all units are sold. A break-even analysis can be used for planning by identifying the level of output needed to cover costs, for monitoring by comparing actual sales with break-even sales, for control by highlighting cost or price changes that affect profit, and for target setting by establishing clear financial goals for the business. Statements of comprehensive income and financial position are key financial documents that show an organization's performance and stability, and they can be used to measure profitability through profit margins, liquidity through current ratios, and efficiency through asset turnover. A statement of comprehensive income is a financial document that records an organization's income and expenditure over a specific period to show overall profit or loss. The purpose of a statement of comprehensive income is to provide stakeholders with a clear picture of how much profit or loss the organization has made during an accounting period. The uses for a statement of comprehensive income include assessing business performance, comparing results over time, guiding management decisions, and informing investors and creditors. The elements of a statement of comprehensive income are revenue, cost of sales, gross profit, expenses, operating profit, interest, tax and net profit. Revenue is the total income earned by a business from its normal operations before any costs are deducted. Cost of sales represents the direct costs of producing goods or services sold by the business. Gross profit is the difference between revenue and cost of sales, showing how efficiently a business produces or buys its goods. Expenses are the indirect costs such as administration, marketing, and utilities that are deducted from gross profit to calculate operating profit. Operating profit is the profit made from normal business activities before interest and tax are deducted. Interest is the cost of borrowing money or the income earned from investments. Net profit before tax is the profit remaining after all expenses and interest have been deducted but before tax is applied. Tax is the amount payable to the government based on the organization's taxable profit. Net profit after tax is the final profit remaining after all costs, interest, and taxes have been deducted. Depreciation is the reduction in value of a non-current asset over time due to wear and tear or obsolescence, and the difference between straight-line and reducing balance depreciation is that straight-line charges an equal amount each year while reducing balance charges a higher amount in the early years. A statement of comprehensive income is adjusted for depreciation by including a depreciation expense to reflect the decrease in asset value, which reduces profit for the period. Prepayments are expenses paid in advance, while accruals are expenses incurred but not yet paid. A statement of comprehensive income is adjusted for prepayments and accruals by reducing expenses for prepayments and increasing expenses for accruals to ensure that only costs relating to the accounting period are recorded. A statement of financial position is a financial document that shows a business's assets, liabilities, and equity at a specific point in time. The purpose of a statement of financial position is to provide a snapshot of a business's financial health and stability by showing what it owns and owes. The uses of a statement of financial position include assessing liquidity, measuring solvency, evaluating financial structure, and supporting decision-making by managers and investors. Non-current assets are long-term resources owned by the business such as property, equipment, or patents that provide value over several years. Tangible non-current assets are physical items like buildings and machinery that are used in operations to generate income. Intangible non-current assets are non-physical resources such as goodwill, trademarks, or software that add long-term value to the business. Cost represents the original purchase price of a non-current asset before any depreciation or amortization. Depreciation and amortization are methods used to spread the cost of tangible and intangible assets over their useful lives to reflect their gradual loss in value. Net book value is the value of an asset after accumulated depreciation or amortization has been deducted from its cost. Current assets are short-term resources expected to be converted into cash within 1 year. Inventories are goods held for resale or production that represent a key part of current assets. Trade receivables are amounts owed to the business by customers for goods or services provided on credit. Prepayments are amounts paid in advance for goods or services that will be received in the future. Bank refers to the cash held in a business's bank account available for immediate use. Cash represents the physical money held by the business. Current liabilities are short-term debts that must be paid within 1 year. A bank overdraft is a facility that allows the business to withdraw more money than it has in its bank account. Accruals are expenses that have been incurred during the period but have not yet been paid. Trade payables are amounts owed by the business to suppliers for goods or services received on credit. Net current assets or liabilities represent the difference between current assets and current liabilities, showing short-term financial health. Non-current liabilities are long-term debts that are due after more than 1 year. A bank loan is borrowed money from a financial institution that is repayable over an agreed period. A mortgage is a long-term loan secured against property or land owned by the business. Net assets are the total assets minus total liabilities, representing the business's overall worth. Total equity represents the owner's interest in the business after all liabilities have been deducted from assets. Opening capital is the amount of money or assets invested in the business at the start of the period. Transfer of profit or loss represents the movement of net income or loss from the statement of comprehensive income to the capital account. Drawings are withdrawals made by the owner for personal use, reducing the business's capital. Closing capital is the final balance of the owner's equity after adding profits and subtracting drawings. Adjustments for straight-line depreciation are made by applying a fixed percentage of the asset's cost each year to calculate the annual depreciation expense. Adjustments for reducing balance depreciation are made by applying the depreciation rate to the asset's net book value after previous depreciation has been deducted. Adjustments for prepayments are made by reducing expenses to remove amounts paid in advance that do not relate to the current period. Adjustments for accruals are made by increasing expenses to include costs incurred during the period that have not yet been paid. Profitability is the ability of a business to generate income that exceeds its costs and expenses over a specific period. Profitability is measured by comparing profit figures with sales, assets, or capital to assess how effectively a business uses its resources to earn returns. The different types of profitability are gross profit margin, markup, profit margin, and return on capital employed, each providing insight into different aspects of financial performance. Gross profit margin measures how efficiently a business produces or buys goods compared to its revenue and is calculated as gross profit divided by revenue times 100. Markup measures the percentage added to the cost of goods to determine their selling price and is calculated as gross profit divided by cost of sales times 100. Profit margin measures how much profit a business makes from its total revenue and is calculated as profit divided by revenue times 100. Return on capital employed measures how effectively a business uses its total capital to generate profit and is calculated as profit divided by capital employed times 100, where profit for the year equals revenue minus cost of sales and expenses, and capital employed equals total assets minus current liabilities or non-current liabilities plus total equity. Liquidity is the ability of a business to meet its short-term debts as they fall due using its current assets. The different liquidity ratios are the current ratio and the liquid capital ratio, which both assess the business's capacity to pay its immediate obligations. Current ratio measures the relationship between current assets and current liabilities and is calculated as current assets divided by current liabilities. Liquid capital ratio measures a business's ability to pay short-term debts without relying on the sale of inventory and is calculated as current assets, inventory, divided by current liabilities. Efficiency is the ability of a business to use its resources effectively to generate income and control costs. The different ways of measuring efficiency are trade receivable days, trade payable days, and inventory turnover, which each assess how well a business manages its working capital. Trade receivable days measure the average number of days it takes for a business to collect payments from customers and are calculated as trade receivables divided by credit sales times 365. Trade payable days measure the average number of days a business takes to pay its suppliers and are calculated as trade payables divided by credit purchases times 365. Inventory turnover measures how quickly a business sells and replaces its stock within a period and is calculated as average inventory divided by cost of sales times 365. The limitations of using ratios when assessing business performance are that they can be affected by external factors, rely on historical data, may not be comparable across businesses, and can be distorted by accounting policies. One limitation is that ratios can be affected by external factors such as changes in the economy or market conditions that the business cannot control. Another limitation is that ratios rely on historical data, which may not accurately reflect current or future performance. A further limitation is that ratios may not be comparable across businesses due to differences in size, industry, or accounting methods. An additional limitation is that ratios can be distorted by accounting policies or estimates, reducing the reliability of comparisons and conclusions. Thank you for watching this video on personal and business finance. I'll see you in the next one.